I've been brushing up on all the expectations for the Fed, and that's really what this boils down to be. I don't think the language is going to change. I think that the testimony today and tomorrow, the only thing that might be a little bit wild and crazy would be the Q&A sessions and stuff that comes off randomly for the headlines. But yesterday to today, right? Yesterday, everything was risk off. Gold was up, bonds were up, market sells off aggressively. I did want to show something interesting. I just finished up a live session this morning, and I can't help but notice a couple of things here. Let's take a look at the SPY. Let's take a look at we've said here for the last, couple weeks now, 16 out of 18 weeks, we're getting long in the tooth. This market needs a correction. If I go into, let me share my screen here if I can. I meant to do that earlier.
Yeah.
1 second. Here we go, Nick. Right here. I just want to talk about the market structure for a second. Let's try to look through the noise in my screen. I'll just go back to this chart here. This will be a little bit easier. SPX right here. So one thing I'm looking at just in the recent move. So we had this corrective move in 2020. If this is a 1, 2, 3, 4, 5, if that is right, anytime we have 5-wave structure and that 5th wave is completing, we typically see an ABC correction pulling back to a previous high and testing that 4th wave. So again, I don't know when the catalyst is going to officially hit the market. It seemed like yesterday was kind of the starting point, like things were kind of pricing in, like, oh, we think Powell's going to say something that we don't want to hear, so the market sells off aggressively. There could have been some heavy profit taking yesterday, but it didn't seem like a profit taking day when bonds were up, gold was up. It seemed like a risk off type day. The one thing that I see here is like SPX, I see that wave structure. And then also I looked at Bitcoin today as well and kind of looked at the same thing. Again, if I'm right, 1, 2, 3, 4, 5. So another reason that kind of justifies why I think we can have pullback material on, Bitcoin pulling back for an ABC correction, possibly coming back some of these inefficiencies, the SPY as well, the Qs as well. It just adds, and I don't know if it's Powell this week with the testimony in 2 days. I don't know if it's non-farm plus CPI, PPI, or if it's the Fed. The expectations haven't shifted a lot, right? I mean, we still expect the Fed to do nothing in March and probably not anything until what, June or July. That's going to be like our first cut. So this is our first rate cut potential at the highest probability, 58.7 in June for the first cut. So March is a nothing burger. There's no Fed decision in April. May is still expected to be the pause with a high probability here. So if this shifts and changes today, tomorrow with the testimony, maybe. But I don't know. What do you think, Nick? This probably won't take place until FOMC March 20th, in my opinion.
Well, there's 2 things here that I really want to talk about, Chris. So first of all, we can knock out the data, which has been okay. You've had PMI numbers come out cool. This morning we had the private sector that looked a little bit cool with ADP numbers. At the same time, you look at the reads on inflation. We will get new rounds of that data for February pretty soon. But what we have on the table right now is inflation that's staying stubborn, growth that is being challenged. This picture of the U.S. economy cannot be stopped is being challenged. Consumer sentiment was weak, PMIs were weak, advanced GDP was 3.3, but then the preliminary came at 3.2. So there's enough stewing here to justify. I just had this whole rant before you got on, Chris, just about how a lot of people are like super frustrated with the price of gold, thinking, it can't be at where it's at. This is ridiculous. I was making the case this is straight up the alley for gold on a rally when you have cooling economic numbers, but at the same time, inflation is not, we're not seeing smash hit, in line with 2% numbers. There's one other side of that I want to bring into your attention. We were talking about this earlier. But are you familiar, Chris, with the bank term funding stuff that they did back last year for the banking crisis that we saw with Silicon Valley Bank, et cetera?
Bank term funding stuff. No, I haven't heard that. No, I
Well,
know
okay.
that the backstop, like the bond exposure, was what I thought would declare
Yep.
them insolvent, where they had like 10-year, 20-year treasuries. They needed liquidity up front, and they had to basically take
Yes.
bond prices at 60 cents on the dollar just to have cash, and that's why they were declared insolvent.
Yep. Okay.
Yeah.
So check this out.
Okay.
Fascinating stuff. Someone in my audience pointed this out. This expires, by the way, March 11th. Okay. We're in March 6th. This is, you cannot
Ah.
make this up. Look at this. They did a 1 year program where they helped out. Basically, they gave a bunch of free money. This was a stimulus under
Oh,
the
for sure.
hood, secret stimulus event that took on. It wasn't secret. People were talking about it a lot at the time. I had to review it this morning because but someone sent this to me and they said, "You want to know why gold is up? It's because this is expiring March 11th." And I was
Mm.
like, well, what is this? What is this creepy, bank term funding program? Basically, it was to help prop up a bunch of banks that could become insolvent.
Oh yeah,
And
it backstop contagion for sure.
yeah, and the
Yeah.
program is ending in March 11th. So maybe, and if you remember, as many people in the audience will, March, April last year, gold was flying high off of these financial, banks potentially going under. If this
Yep.
program ends and stimulus is not rushing to the rescue, that could be a serious concern for financial markets. It's almost like the under the carpet thing that's been, the dust under the carpet that's been swept away.
Yeah.
Uh, was these banks struggling, and interest rates are still at, they haven't changed. And,
Right.
I don't know, something to think about. It's kind of like this back pocket market concern. I think everybody is staring right in the face of like, oh, well, the data could also be another banking situation. So something to think about.
Yeah, it very much could be. And even after last year when the Fed backstopped and also big banks stepped up as well. I mean, JP Morgan came out ahead on assuming, I don't know if it was Signature Bank or Silicon Valley Bank or whatever bank, they're like, yeah, we'll take care of it. And the terms are ridiculously favorable for JP Morgan Chase.
Yes.
Um, we do have tools and mechanisms and programs in place with the largest banks in the world that you still have the Fed, you still have the largest banks. There still is a real backstop potential. So
Yeah.
look, I think regional banks can still fail. I mean, we've heard nothing more than like what's NYCB, right? New York Central, NY, is that the ticker? Regional
NYCB.
bank,
Yep.
NYCB, is that what the one? Yeah, New York
Yep.
Community Bank Corp. Just absolutely getting murdered out there. And
Yep.
what happens to them? I don't know, but I mean, the stock market's still making all-time highs. AI is
Yeah.
making all time. It's like, so this is going to happen whether we care about it or not. It's like, so having the threat of like banks closing and smaller banks closing, it's like there's just going to be concentration. I mean,
Yes.
we have all sorts of phases where I just saw you talking about, all-time highs, especially after corrections, are really important because the momentum is there.
Yes.
Underneath that hood, there's still going to be banks that fail. There's still going to be businesses that fail. There's still going to be, the S&P 500, 480 companies that don't do well, right? But it's just being carried so much more so now by high market cap, high concentration, and look, you can have the narrative and you can fight it all day, but if the market's pushing higher, you're just arguing against it. So I mean, I
Exactly.
don't want to be that type of trader where it's like I can sit here until I'm blue in the face and just argue against what I see when look, I think that the technicals are there for a correction. I'd like to see that materialize because it would make some sense, but I'm not necessarily only positioned for it. In
Yep.
fact, I position for gold, like gold. I mean, I know Frank and I stayed a little bit longer yesterday, but in gold, I mean, I'm going out a little bit further. I'm taking a stab at it through some options, and here's a play that I'm looking at for GLD. So I'm starting off out of the gates pretty solid today. I've got Altria. I think we talked about this on the show last week. I'm doing this as a dividend play. I've got some pretty good profits rolling in there. I'm up 12 grand on the day.
Mm.
If I go into GLD, I started to establish some positions here. So let me just pluck one account out. That'll make it a little bit easier. So I'm doing some out of the money bull put spreads on silver futures, silver and gold, and then I also took a 190 call and I sold a 200 against that. So right now we're trading at 198.47. If this gets called away this week, I'm still going to make about 105 bucks on gold. um, which again, not a big deal. But I'm going to roll this call out, and I'm going to give myself more time. And I think that I'm going to give it a chance. I want to give gold a chance and see if this is the real deal breakout
Yeah,
on XAU USD. I mean, there's very little that tells me, oh man, this is a fake out. I mean, holidays was a fake out. That was a low liquid
sure.
spike that came out of nowhere, but GLD didn't reflect that. So I look at this run up move. I mean, we've had a 2018 to 2020 run up, and we've been in a 2 year plus range. I mean, that's a high in 20. I mean, this is a 3.5, 4 year range. Just measure the move. That's literally what this is right here. That's a measured move. So we have this range. If we have this breakout,
Yep.
that's my target on gold. It doesn't need to be any more complicated than that. If we
Yep.
support this price action and gold is continuing to make higher highs, I'm taking gold up to 2470. It's that
I like
simple.
it. I
Yeah.
like it, Chris. And you know, I just want to real quick cover what's just happened. We just had the Bank of Canada. They did hold rates steady. Now, again, as I mentioned this earlier, guys, in terms of Bank of Canada and impactful to both Chris and I's gold positioning is anytime a central bank reports. Remember, they move. I made the Buffalo monologue earlier. They move like buffalo. Central banks move generally like a herd. So if there's you know, cooling in outlook or more hawkish outlook, they generally move together. Anyways, dollar CAD, Chris, this is a big move. You know, 20, well, not really a big move, 20 something pips here. But it is, you know, gold not even phased by what's happening there. But yeah, I didn't mean to cut you off, but just wanted to illustrate that. And I mean, I agree with you, Chris. I saw somebody on I mentioned this earlier in the stream. One of my other trading friends, Joe Barreca, he was getting he bought gold 2 days ago, like right as it was crossing the all-time high, and he said fundamentals bullish, and I was just like, you know, as crazy as it sometimes sounds. Um, and again, the retail trading crowd will look at gold hitting all-time highs and they will try and absolutely just short the heck out of it. But as we
Mhm.
talked, as you heard a little bit earlier, all-time highs, they can be very bullish signals, um, especially after a consolidation phase. Or, and I really like the way you broke that out, a measured move there. Where
Yeah.
did that land you for 2400?
2470 to the upside, 2470. Yep.
Yep. Sounds crazy
And
until it happens, Chris. I think, you
right.
know, I remember when thinking 1,500 on gold was like ridiculously high, and now it's like you could pick up some gold at 1,500. You'd be bargain hunting.
I mean, people would be I mean, what happened at Costco when they had 2-ounce gold bars? They sold
Yeah,
out.
yeah,
So
yeah,
it's interesting, and again, it like I said, doesn't have to be any more complicated than a measured move, and
yeah,
that's the beautiful thing about fundamentals and technicals blending together. I've never met a trader that's pure fundamentals. I've never met a trader that's pure technical. Forex is probably the most technical market we can trade, right?
mm,
You can ignore the news altogether. You really can. You can block out all the news and take out all the noise. You can trade Forex charts and just be technical and probably be really successful. But the
yeah,
awareness that you need to have for fundamentals to at least recognize like, okay, all of a sudden this technical look starts to break down. I mean, especially if you trade the Japanese yen. Japanese
yeah.
yen, flash crashes, that stuff makes no sense technically. Um, but at the same time, like it's just part of the arena that we're in. But
And
Forex is very purely
oftentimes, Chris,
technical.
those moves just correct themselves, and it's back to
Oh, for
technicals
sure.
pretty quick. Also, I just
Very,
wanted to
very
mention this
efficient.
is kind of cool. We did this yesterday. Yesterday, we were on camera together as Bitcoin hit its all-time high. Now, we might experience together here as an audience gold hitting its all-time high intraday. We've been closing all-time highs every day for the last several days, but we are knocking on the door here,
It's right
guys, at
there. Yeah,
2,150. So crazy. And again, I'm with you, Chris. I think it has room to run. It's
I do
this
too.
this is looking more and more real. And when you tie slowing growth, stubborn inflation, and the bank term funding program stuff, even if that's
Mhm.
not an actual event, the fear of it, the concern around it is enough to get the gold market moving. So kind of crazy.
And also, I think you had mentioned this yesterday. There's probably not a lot of traders. I personally was not like super convinced on gold that this. I mean, I like this posture, and I said early in the year my bigger projections and forecasts like I like silver this year. I like gold this year if
Yeah.
they prove that they want to break out. I mean, silver to me has to break above 26. Way more
Yep.
bullish on silver above 26. Gold is making the move. So a lot of times, let's say gold starts that move, establishes that trend, and then silver plays catch up. That makes sense. Like we get those
Yeah.
ratios to fall back into line. But
No,
when
you're
we
totally
came into
right.
the market this year, it's like I took even in the trading battle, which by the way, you're going to be on later
Yep.
this month. Yeah.
Mhm.
And so in the trading battle, I took a position here when we had CPI data and gold got a little bit weaker. I'm like, okay, if we're going to poke down through this yellow box, I want to look for a short term move to the downside in gold and then start picking up some 1900 levels to start buying again. My initial plan this year was if this resistance holds and we have a little bit of a correction on gold this way or fall into this midpoint, buy at the midpoint, buy at the lows, still be long term to the range. But now that
Yep.
we've quickly turned, this to me is way more convincing. I said above 2090 and 2100. This week, I want to see it close above, right? We close above, and then I want to see it hold and hover, either a bull flag for more or a pullback and retest for more. But I don't think a lot of traders were participating in this move right here. And so
No,
just
and
the flood into that alone could be where this thing gets really overstretched. And then we just look at bull flags and pullbacks. But that would just put the posture in place where all-time highs, bullish posture, technicals look very, very solid for more
no, and Chris,
gains.
I've got the data to back you up too with that. I mean, participation is very low. Retail traders, from the positioning tracker that we've got, what this does, it takes a bunch of data from a bunch of brokers and kind of
Yeah.
consolidates it. We're looking at retail traders not participating at all, and meanwhile, commitment of traders data is super bullish on gold. So
Mhm.
you've got kind of institutional money cashing out, and retail traders holding the bag right now on the shorts. So sometimes this happens rarely in markets where it's just such a clear directional move, but um, again, I think that short squeezes are a real thing, and it's also, an indicator I'd be so keen on studying or building would be like and Frank and I have talked about this. We kind of want to build something for the Edge Finder that would go scan keywords on news outlets and
Mhm.
look at, like, the number of times that gold gets mentioned today is going to be 50 times what it was being spoken about on news outlets than when it was just chopping and doing nothing.
Yeah.
So and that's an indicator, right? A lot of
Absolutely.
retail money
Sentiment
is
driven.
going to, yeah, it's going to push into this. And
Yep.
that's not a move you want to fight against, even though it's not necessarily the smartest money in the world that buys the all-time highs. It's certainly not something you want to push against. That's like a river flowing towards you and you're trying to, like, hold back.
Yeah.
It's just something to think about.
That type I mean, let's say you guys build that and you just it's really like a keyword sentiment search,
Yeah.
right? But
Yep.
if you did the same thing in, 2023 about AI, every transcript, every earnings call, if it was mentioned,
Oh
it
my
was up.
gosh. Yeah.
Anything on semiconductors. It's like those keywords, like the market latches on to these hype, trendy
Hmm.
words, and like everything gets around it, and like you will see momentum and pushing and crazy moves behind all that stuff. So yeah, I mean, it's scouring transcripts and it's scouring earnings calls and it's scouring headlines and it's going to be a dig for sure. But I think
Yeah.
it's very valuable when like the information that we digest every single day, it comes at us fast. The market, takes it in, does crazy stuff. I mean, I don't know what you want to use as like an analogy for most of what it feels like to be in the markets, but we're trying to be calm, cool, collected. We're trying to make good decisions and trade probabilities. But it just seems like, man, it is shiny object after shiny object of like, I want to buy this and I'm going to do this and just throwing money at stuff. And that's
Yeah.
what it seems like. But it's just kind of
Yeah.
controlled chaos that we have to kind of wade our way through.
No, there's somewhere in there, Chris, that makes a lot of money between being greedy and chasing the hype, but also recognizing the flow of traffic. Like there's
Yeah.
a middle ground, and I think we've both illustrated bullish indices, but be calculated. Don't you're taking, when you buy Nasdaq at the highs, you're taking
Mhm.
max risk to reward, right? Because especially when we're in unprecedented territory, your risk, I mean, you could have a very normal, healthy pullback, but if you're going to put a stop on that, you're going to have to put it way far away. So I feel like the risk to reward gets juicier on indices, et cetera, when you do in fact get that pullback and you can still do a measured, let some of that hype fade. That's when you trade it long. And you can join hype in a calculated way. I think you just wait for the hype to wear a bit. Like there needs to be, and I say this often, for me to really be bullish on something and actually
Mhm.
take a position, there needs to be a bear case. And for me to be bearish on something, There needs to be a bull case, because with that bull and bear case coexisting, you actually get good risk reward. That's
Right.
why, you don't buy stocks at the all-time highs, because there's no bear case that's prominent. If you see stocks pulling back, you've got probably a bear case that's baked into that move, and I prefer to be a buyer in that environment than just buying along with all the other bulls that are. And again, you can actually make great money. I mean, look at the problem is too, though. You go to QQQ, and if you said that, that you would sound like an absolute dummy if you did that, in the .com days, right? This is the notable chart. Frank and I were
Right.
staring at this yesterday. You would have it's the easiest printing money in the whole world. Just buy the NASDAQ every day. And then you had
Mhm.
an 80% pullback. So you have to be
Yeah.
careful with hype, but bailing on it quick, but also knowing when it's time to ride and when it's time to bail is important.
Yeah, and that too, that speaks to diversification as well. I mean, I talked about that not too long ago on looking at the Nikkei 225 finally breaking out after a 14-year. I mean, the 14 years that
Yeah.
the Nikkei's been from the lows has been performing great, but it's also been in a
Yes.
34-year drawdown. So the reality is,
Yes.
you could have been all in on the Japanese index and had a 34-year drawdown before you get to these all-time highs. But over 34 years,
Yep.
if you're an investor with a long time horizon, that's the classic lesson of stay invested in the market, and the market works its way back, and things happen obviously. But if you diversified and it's not just all Japanese index exposure, it's not just all US exposure. I mean, I'm all over
Yes.
the place, right? It's like I've got some index exposure, I've got some individual stock exposure. I'm bearish on some, I'm bullish on some. Option
I've
tells
got
me
some
do that.
China exposure, Chris.
So do I. I mean,
FXI.
I look, I'm partially bullish on China right now because everyone else hates it. I mean, everyone's
Yeah.
talking about like how
A little bit of
bad
a
and how
contrarian
uninvestable
move.
China is, and it's just like it's definitely to me a contrarian play. And some of the biggest turning points we've seen in the market have been because of contrarian plays. Last October, that point we had at the bottom last year before we had a rally that's still going today was because CTAs were positioned extremely short on the market, and it
Mhm.
was a
Yep.
complete contrarian play. So
And that's
that
great,
happens,
Chris.
and
I made
yeah,
that point too. I'm so glad you brought that up. People look at 2023 right now. A lot of people, I've seen this so much echoed through Twitter, Instagram, YouTube. Like, oh, all you got to do is be a bull, be a Nasdaq bull, buy dips, buy everything, and just buy, buy, buy. But their base case is looking at 2023 exactly as you mentioned. There was no bull case. There was only a bear case, and
yeah,
that's why the risk to reward became incredible, right? If you were the one bull in the room and suddenly everybody has to turn and go back to you and buy from you, you're going to be a real popular guy. That's pretty much what happened in 2023. So I warn people too, if your base case for indices, if your back testing only extends back to 2023, go ahead and add 2022 in there. Go ahead and go back to 2015 and 2018 and 2020 and try those out for size. And if you still feel confident in your strategy, then great, you probably have something. But you've got to be able to trade the good environments when it's straight up and the bad ones. And 2022 was a tough year for me. I think I had my drawdown, I think on my account was about 29% or 30%. And
yeah.
so closer in line with the NASDAQ's drawdown than even the S&P is just because my tech exposure.
Yeah, I just saw. I think I took a screenshot of this yesterday. 2022 is no joke. I don't know if you know this, but top 10 drawdowns and pullbacks in the markets. 2022, I think, was like 8 out of 10 all-time historics.
Yeah.
1931, I think, was the
We
worst.
survived it, Chris. We made it through.
Yeah, so 1931, it was a 52.3% return for the S&P 500. So that was the worst in history. 1931, the annual return of the S&P was 52%. 1937, 2008. I'm just going in order of like worst to not so, but 1941, 15%. 2022, what is that? 1, 2, 3, 4, 5, 6, yeah, eight. Eight all-time worst at a 20.27% return. And then look at 2023, complete reversal.
Yeah.
When you mentioned go back, right? If and this is what was, I just kind of had to sit back and smile a little bit in 2022 because, yeah, I battled the markets. I had some drawdowns. I maintained positions that I liked, and 2023 helped a lot. 2023 was great to
Yeah.
kind of have my, positions and convictions be vindicated and validated because,
Yeah.
2022 is a great year. But if any trader out there has come through now and still trading from 2019 to present. Let's give yourself a 5-year history. We've
Yep.
seen some stuff, right? I've been trading since
Certainly.
2000. I've seen some stuff. But
Well,
2019
yeah,
to
and yeah,
2020 to 2024, it's like that 5-year window. We have had some crazy reactions in the market where, yeah, man, like this is what trading can be. It's not easy. If it was easy, everybody would do it. And so, the bull market geniuses are like, just buy everything. It's like, right. And then 2022
yep,
happens where you see what it's like to experience everything going down, and you can't be
yep.
right. And it depends on how you're positioned. It depends on how stubborn and greedy you are. Because as they say, bulls and bears make money, but pigs get slaughtered. You know.
That's right. That's right, Chris. We just had Jolt's numbers come out as well. Job openings came out pretty much in line with expectations. These are, of course, open positions available, and a higher number here is going to be, of course, showing demand for labor, but a lower number is lack thereof. Came in line with expectations. Now, I guess the big event we'll be waiting to hear from Jerome Powell and his testifying on Capitol Hill. I don't want to keep any longer, Chris. I do want to thank you. We got to keep the show moving here. But before we let you go, let me just say to everybody who's watching, if you enjoyed our conversation, do me a favor. Chris has a Discord channel you can join. He also has a YouTube channel that is free. So if you guys are looking for some free value, you have to go no further than checking out Chris and what he offers on his channel. So click this link. Make sure to go follow Chris Pulver. Again, always a great time having Chris on the show. Some of our conversations are some of the best that I've had, at least on this show, I think. So Chris, thank you very much for coming on here today and sharing some wisdom with us.
Good stuff, Nick. Thanks. Hey, real quick before I go, Powell, this came up just before. I know that the testimony is coming out now, and there's going to be a long Q&A session. We do not expect it will be appropriate to reduce policy rate until we have greater confidence in inflation moving sustainably towards 2%. It
There you
will
go.
likely be appropriate to begin dialing back policy restraint at some point this year. He literally says one thing the market doesn't want to hear, one thing the market wants to hear. This guy is so calculated and so
He's
good that
calculated, man.
it's like spot on. So anyway, just leave you with that, and thanks for having me on.
Yeah, of course, Chris. Thank you very much. And again, guys, make sure to go follow Chris. Got great value on his channel. And Chris, we'll see you next time.
All right, thanks, Nick. Thanks, everybody.
See ya. Yeah, again, guys, 10 out of 10. Always great wisdom coming out of Chris. He's been trading a lot longer than I have, and I've learned something every time we talk. Anyways, reaction here so far. We do have that pulled up, but Chandler, you can take over the screen whenever it does start, when you actually have something of substance. But from what I can tell in the streaming software, we don't have anything just yet. Again, the Jolts jobs came out as expected, pretty much. Powell testifies, and I'm just going to pull up my Twitter really quick. Twitter is my reliable source, and I can't call it X, man. Are you kidding me? Everybody wants to call it X now. Well, I don't know if everybody wants to call it X. I think it's just the the majority shareholder that wants to call it X, Mr. Elon. Yeah, again, a lot of people in the chat saying thank you to Chris. Yeah, seriously, guys. I mean, come on. That is some free value if you ever saw it. Chris is a remarkable guy to have on the show, and really thankful to hear him give us a little insight. They also revised the number down also from 9.03 on the last Jolts job openings. Worth mentioning there. Let me see. Let's see. And again, we're waiting for updates here, guys. We'll have some live coverage for you pretty soon. So far, markets, S&P giving back a little bit of its gains. NASDAQ as well. Dow, dollar index down. Excuse me 1 second as I blow my nose. Allergies are still getting to me, guys. Anyways, dollar index is getting beat up here a little bit. And I think I'm going to probably, oh, look at this gold pulling back 2137 now. NASDAQ pulling back. Look at oil. Oil is undefeated, man. It's been the low key killer in my account right now. Oil back up to almost 8 grand in profits here. 4 grand in gold. Silver's up 519. There's my current positions. I trade ETFs, by the way. If you're wondering which broker I use Webull. In the US, you can trade futures or ETFs, but if you're looking for a broker, excuse me, we'll drop that link here in the chat. Anyways, I think we have something, but it's not JP just yet. So stay on the line, guys. Volatility is likely to happen for the next hour or so during this event. And when it comes up, I'm going to probably back out for a second and just run to the restroom. I got to pee.
Opening statement.
And I'll listen on my phone.
Welcome back, Chair Powell. Since you last appeared before the committee in June of 2023,
okay, we got
conversation
something,
in
guys.
Washington surrounding inflation has shifted significantly. To be clear, it's not because the inflationary fire has been extinguished. From the most recent data available, food costs are up 21% since President Biden took office. Energy costs are up nearly 32%. Shelter costs are up more than 19%.
I'm going to back out for a second, guys. I'll be back in just a moment.
You'll pay 37% more for a dozen eggs in America today. As you stated in January, people are still paying more for the basics of life, and the prices they're paying are still high. Families aren't happy about it, as you know, and as our colleagues know. But according to the Biden administration, many of my Democrat colleagues, they should be thrilled. In an attempt to score political points, many in Washington have decided the best strategy is to tell people what they're feeling isn't actually accurate. They claim Bidenomics has brought down costs, and their partisan so-called American Rescue Plan put our economy back on the right track. Of course, we know the opposite is true, since inflation skyrocketed soon after the American Rescue Plan was enacted, which was predicted by several former Obama administration economic officials. Instead of working to solve the underlying issues causing high prices, the administration has played the blame game, citing corporate greed and so-called shrinkflation. Some Democrats have even trained fire on you, Chair Powell, blaming interest rate hikes, which were necessitated by Democrat spending, for the high cost and brazenly calling you to make cuts prematurely. It's highly inappropriate for lawmakers to attempt to influence monetary policy. Chairman Powell, I have faith that you will not allow politics to cloud your judgment in the fight to tackle inflation. As I have always said, you're a steady hand, and I believe you are committed to the Federal Reserve's independence, as am I. Just as you have rejected the outside pressures of politically motivated agendas, I hope you will be just as attuned to the threats of politicization when the calling is coming from inside the House. Vice Chairman Michael Barr's so-called holistic review of capital requirements and the fatally flawed Basel III endgame proposal represent a concerning trend of partisan proposals taking priority over supervision. This has real-world impacts, as we saw 1 year ago this month when the supervision and regulation arm of the Fed was late catching up to the effects of the acceleration of interest rates on the banking system. Americans were understandably shaken by last year's banking turbulence. As we continue to monitor potential instability, including bank exposure to commercial real estate, it's critical that the Fed keep its eye on the ball. This does not include enacting new, far-reaching, and ultimately harmful regulatory policy, though. As you know, members on both sides of the aisle, on this committee and in Congress, have made clear that the Basel III endgame proposal would be catastrophic for families, communities, and small businesses. Regulators should withdraw it and start over. I think that's the proper course with something as deeply flawed as the current proposal. Additionally, given that other significant proposals would have to fit holistically together, regulators cannot simply proceed with them as separate modules or using a cut and paste approach. Most importantly, as the Basel III endgame proposal is discarded or altered, I strongly urge you and other regulators not to finalize your the long-term debt proposal. Instead, Chairman Powell, I would encourage you to stick to the task at hand and follow the data. The stakes are way too high to put politics over sound policy. With that, I yield back, and I'll now recognize the ranking member of the full committee.
Thank you very much, Mr. Chairman. Good morning, everyone. Welcome back, Chair Powell. While I am pleased by the progress the Fed and the Biden administration have made to tackle inflation, we're not out of the woods yet. In fact, even though my Republican colleagues refuse to acknowledge this fact, housing is still the #1 driver of inflation. Based on the latest data, housing costs continue to make up nearly 70% of overall price increases, outpacing modest wage gains. This means that until we address the underlying housing supply shortage, Americans will continue to pay an increasing share of their income on housing. The affordability crisis will worsen and inflation will remain too high. With that said, it's hard to understand why Republicans feign concern about the economy when they're unwilling to address the key driver of inflation, housing. In fact, Republicans have only put forward legislation that makes things worse for millions of Americans, including moving legislation to slash funding for federal housing programs, including in rural America, where homelessness is rising. This abysmal record on housing is par for the course for Republicans. Since they have been in the majority, they have convened only 6 hearings on housing, on top of launching baseless impeachment efforts, censoring members, and pushing our government to the brink of multiple government shutdowns. It's clear that Republicans are too focused on drama and chaos to deliver anything for the American people. That's not how Democrats roll. When I was chair of the committee during the 116th and 117th Congress, not only did we hold 55 hearings on housing, but I and my fellow Democrats enacted 12 critical housing bills into law in the last Congress alone that helped stymie a tsunami of evictions, foreclosures, and homelessness, keeping millions of people stably housed during and after the pandemic. Unlike Republicans, we don't just talk about the issue. Democrats make law. As House Republicans continue to disappoint, committee Democrats are offering evidence-based solutions to keep a fair and affordable housing agenda at the top priority in Congress. That's why I and my Democratic colleagues reintroduce 3 groundbreaking bills to address the housing crisis and bring down inflation once and for all. This includes Housing Crisis Response Act, the Ending Homelessness Act, and the Down Payment Toward Equity Act. Together, these bills would create nearly 1.4 million affordable, accessible, and resilient homes, reduce housing costs in homelessness, and revive the American dream of home ownership for all. So, when my Republican colleagues are ready to get serious about our nation's economy and inflation, Democrats are ready to work with you to pass the bills into law. In fact, tomorrow at noon, I, committee Democrats, and more than 30 housing advocates will join together at a press conference to share just how important ending the affordable housing crisis is to the state of our union. And so I invite all of my Republican colleagues who say they care about this issue to come on and join us. I look forward to discussing this critical issue with Chair Powell today. And Mr. Chairman, I yield back my time.
Chair recognizes Mr. Barr, Chairman of the Subcommittee on Financial Institutions and Monetary Policy, for 1 minute.
Welcome, Chairman Powell. Runaway inflation and increased interest rates still have Americans reeling. And while the rate of price increases have come down thanks to monetary tightening, the overall level of prices remain high. The toothpaste is out of the tube, and Americans, the average American family still is paying about $15,000 more for the same goods and services that they were purchasing just 3 years ago before the Biden administration. So Americans have suffered years of eroding purchasing power in their paychecks. And while I'm pleased the Fed is resolved in getting inflation back under control, I'm not pleased by the numerous recent unjustified, politicized, and underanalyzed regulatory proposals. The Fed needs to withdraw and repropose the irredeemably flawed Basel III Endgame proposal, especially given that 97% of public comments across the ideological spectrum expressed disapproval of the proposal. Chair Powell, I urge you to listen to the American people, withdraw the Basel III Endgame proposal, and tell us today what the Fed's plans are moving forward. I yield.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair Powell, for being here today. And I had a chance to actually read the monetary policy report from cover to cover, thanks to an exceptionally long airport delay, going back home last weekend. And the feeling I got again and again is that things are fairly well recovered from COVID and getting back to normal, that we're in the range where ordinary monetary policy and fiscal policy will allow us to satisfy your dual mandate. Today, unemployment remains near historic lows. Core PCE inflation is down to 2.8% year over year, compared to a peak of 5.6% in 2022. And the major stock indices are hovering around record highs. GDP growth continues to beat expectations, and the U.S. economy has added more than 14 million jobs since President Biden took office. The GDP itself is pretty much back on the trajectory that it would have been pre-COVID. U.S. manufacturers alone have added nearly 800,000 jobs, employing more workers now than any point since 2008. And so my lesson from that is that the fiscal response that we engaged in was appropriately tailored, and the soft landing is within sight. Thank you. I yield back.
Gentleman yields back. Today, we welcome the testimony of Jerome Powell, Chair of the Federal Reserve's Board of Governors. As you know, you'll be recognized for 5 minutes for a summary of an oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. Chair Powell, we're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As the labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. And I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve. And we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to? And do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening to these comments that have been nearly nearly unanimous in opposition to this rule? Is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right. We've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out. You would not rule that out at this stage of the game, reproposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does the economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that. This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the three components that we look at that make up the core PCE index, and it has been coming down from its heights of a couple of years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's
And then
been
that leaves
reported that the
non-housing
methodology used to assess housing costs as an indicator of inflation is imperfect. Namely, because it considers costs based on both new and old rents, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics. And you all discuss the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively, but yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets. in abundance of caution in case there needs to be a resolution, obviously. We know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level. And that seems redundant to me. Are you aware of that? And have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back. And so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households. And in my view, there's three principal causings. Certainly we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at, but the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks. And so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference, because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains were disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the, of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet, just about. Is that not correct?
I think that's right. Yeah.
And I think that you also recognize a mismatch between the strength of the economy, that's what we're talking about, in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high and people. So that's something else that we need to get in control. Is that not correct?
Yes.
And let me just ask this. Can you say that there's a connection, for example, between conflicts in other areas of the world, like Russia's war against Ukraine and/or the turmoil in the Middle East and the economic pressures that the United States feels? Does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly the war in Ukraine caused commodity prices to move up sharply.
So could you tell you what is the, what would the connection lead you to believe that there is an urgent need for us, I would think, for, when we're running out of time, for us to do everything that is in our power in Congress to support Ukraine, so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction. So I wouldn't have an opinion on Ukraine funding.
But if we had more grain that was going through, it wasn't blocked by Russia, things of that nature, that generally just, says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia. And we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
I think it's correct that a full supply of grain would help with commodity prices.
And so, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this longstanding work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Boswell endgame warrant a full reproposal to give us time to appreciate their consequences. And there are real consequences, as you and I both know, Mr. Chairman. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. And welcome again, Mr. Powell. It's an honor to have you before us today. I always enjoy hearing your commentary. As you know, recession and inflation, these are buzzwords, and they are used in some circumstances to cast a dim light on perhaps the Fed and others who are working to end some of these troubling circumstances we're dealing with. Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation, and that of other forecasters and of my colleagues, is that we'll see continued growth at a solid pace. I will say, so there's no evidence or no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate you saying this because we want to, at some point, eliminate a great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely. Are you of the opinion that we're headed to a soft landing, Mr. Powell?
I'll just say that what we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand. And inflation has come down sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions, and we're trying to use our policies to keep that growth going and to keep that labor market strong while also achieving further progress on inflation. That's our goal. And do I think there's a possibility we can achieve all of that while keeping the labor market strong and the economy growing? Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. We could possibly have a soft landing and miss the point at which the landing took place. How do you define the soft landing such that a member of the public, a layperson, would understand that we have indeed had a soft landing?
So we really think about it in the terms I just discussed, which is we want to keep the economy growing. We want the labor market to remain strong. 3.7% unemployment is pretty near 50-year historical lows. We want inflation to continue to move down closer and closer to that 2% objective. And we've made quite good progress on that over just the past year. So we want to continue those conditions. And I don't want to put the label on it. Other people can do that. But I would just say we're using our tools to keep a strong labor market and strong growth while making further progress on getting inflation down to 2% for the benefit of the public. That's the economy that we're trying to achieve. And I think there's we're on a good path so far to be able to get there.
Well, I concur, but I would ask this as my last question. Will there be some announcement at some point that we've had a soft landing? Because we have people who are continually indicating that we're not having a soft landing. There's a possibility of a recession. So will there be some official statement that will give people some comfort?
I don't think by us, no. I think we're just going to keep and do our jobs.
That guy's funny. Wouldn't that be nice if they just announced, we have officially had a soft landing?
Declaring victory like that, but
The gentleman's time has expired.
Thank you, Mr. Chair.
thank
The
you.
gentleman from Texas, Mr. Sessions, is now recognized. For
That was
5
hilarious.
Mr. Chairman, thank you very much. Chairman, welcome back. I think we enjoy this.
Can you go ahead and
You do
announce a
too.
soft
I know
landing
there's
for
some
us?
bit of trepidation
No, we
about
won't
all
do
the things that are available to us and you to answer. I learned a long time ago on a campaign trail, every problem can be solved on a campaign. Reality is a little bit different. Welcome back despite all that. Looking at the Monetary Policy Report, March 1st, 2024. And as I review this, I would like to focus on the term that I would say, high prices are here to stay. Because what I've heard you say today in this report really go to is you got everything under control, but we're going to keep the high prices.
Oh my
And I
gosh. this
think
is
the high
frustrating.
prices really take a toll on the American people, as you're hearing from our colleagues, no matter whether they be Republican or Democrat.
I'm just going to mute this guy for a second. What he's asking for is like, hey, can we get prices to go back down? If prices go back down due to being in a deflationary environment, you don't actually want that. That's cold, hard, terrible recession. Prices that are at where they're staying. We all want them to be lower, but the Fed printed $1 bajillion. They're not going to burn all the money they printed. So prices are not going higher. What's more important is the rate that they go up from here, right? If wages grow, but then at the same time, the prices don't grow as fast, then we can get back on track. You're just not going to see prices of goods going down
Texas for natural gas.
unless you have a huge economic recession and nobody can afford anything. And so stores have to lower their prices. You don't want a scenario where businesses have to lower prices. Trust me, that's the worst case scenario. That's 2008.
Through these new fines, but also through the permitting process, we're in trouble. But we're also putting in trouble our contracts that we have with Germany and a lot of other countries. This is going to mean also that business in America continues to have high prices because, as you know, wages are already high and now energy is high. There's no resiliency to continue this and see the American people win.
I'm not going to lie. I think I just generally dislike Congress. Personal opinion.
And what this administration is doing on a policy perspective.
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting.
If you can't tell, I'm super team Jerome Powell.
Report, it arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just going to leave that alone?
Really not appropriate for us to comment. On
This guy, man.
I'm commenting on energy policy. I should comment on everything.
Well,
we have a mandate, which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry. Jobs
long
that are
gold,
associated with it, our foreign
A week
policy
and a half ago.
as it relates to contracts that we have signed with foreign countries, giving up the natural gas market almost entirely on a world market to Qatar. It has a huge impact on whether we are going to keep prices high or control these prices. It has a huge impact on, I think, your monetary report about how many houses get built, how many jobs get filled, whether we have jobs in place, whether we continue to have more jobs available than workers that are there, because over-regulate.
While this guy blabbers on and makes me mad, just a reminder, Edgefinder is currently 25% off while you wait for this guy to finish up. If you want to pick up a copy, 25% off. Use the link that's being dropped in the chat. Is anybody else getting frustrated by this guy's questions? He's like asking Jerome Powell. He's like blaming Jerome Powell for things that the Fed doesn't. They do have involvement in, but it's not what we're here to talk about today.
I have a question, but I want to start by acknowledging, not celebrating, but acknowledging what has been a really remarkable soft landing in our economy. And I'm not celebrating because the American people, consumers, are still feeling the effects of high prices. Wages haven't caught up with prices in some instances. But I think that it would be fair to say that observers would never have predicted the conduct of this economy. You yourself said it in the final press conference of 2023 when you said a very high proportion of forecasters predicted very weak growth or a recession. Not only did that not happen, we actually had a very strong year. So I want to acknowledge that and acknowledge your commitment to independent monetary policy. And because I'm still burdened with this idea that truth and facts matter, I want to point out, especially having listened to my good friend, Mr. Sessions, talk about the energy market, truth and facts matter. We are producing more oil and natural gas today than any other country on the planet. We are the world's #1 energy producer. I could spend my entire 5 minutes sort of pointing out facts. The fact I want to point out here, and this comes right out of the report, is that the premise that inflation is Joe Biden's fault, is fiscal policy's fault, first is faulty because half the fiscal stimulus that occurred in the face of the pandemic happened under the previous president, Donald Trump. and it has faded. And this report makes the case. Core, and I quote from it, core goods prices have been declining as supply bottlenecks ease and import price inflation falls. So, Mr. Chairman, I don't want you to comment on that because it gets a little bit political, but I do think it's important that we keep some foot on the plane of facts. I do want to ask you a question, though, Mr. Chairman, because I always worry about risks that we see and risks that we don't see. And I want to use the remainder of my time to talk about a risk you're very conscious of, which is the overhang in the commercial real estate market. As you know, the Financial Stability Oversight Council identified commercial real estate as perhaps the most salient risk to the financial system, $6 trillion roughly in loans, half of that on bank balance sheets. In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it? It makes me nervous because this has echoes of 2008, 2009, when vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been working hard to management for some time now, really. And what it really is it's a lot of downtown real estate where there's too much office supply because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations, and we've been in touch with them to make sure that they have a plan to deal with that. There will be losses by some banks. It isn't really the big banks. It's really medium and small sized banks that have these higher concentrations. It's going to be with us as a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to take the losses that you're probably going to take. And so that's what we're doing. We're very active in this space with small, medium sized.
So let me ask you about that. Sorry to interrupt, but let me ask you about that. Silicon Valley Bank, wild irresponsibility inside the bank, egregious irresponsibility on the part of corporate treasurers who put so much on deposit. The Fed also had some self-examination to do because the examiners and the supervisors of the bank, quite frankly, were not doing what they should have been. So we might be forgiven for being a bit skeptical of claims of being on this. What has changed in the context of Silicon Valley Bank that gives you the confidence that the supervisors and the examiners will be on top of this?
I see it with my own eyes, but I mean, frankly, there's a risk that we would overreact to something as significant as that. It's not like we wouldn't have reacted very, very strongly to what happened with Silicon Valley Bank, and we have. So I know that our supervisors are out there, and we're hearing back from media reports that we have been engaged with medium and small sized banks principally on this. So I am confident that we're doing the right things there, and I do believe it's a manageable problem. If that changes, then I'll say so.
Thank you, Mr. Chairman. Yield back.
The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Powell, for being here today. I'd like to associate my remarks or myself with Mr. Hill's remarks earlier with regards to FDIC proposed long-term debt requirements that are based on the risk weighting of assets. I think it's an ill thought out proposal, and hopefully your position on FSOC, you'll be able to advise them and hopefully guide them that this is going to be held up until we actually get a Basel III rule. In October 2023, the board issued a proposal to update the debit interchange fee cap and regulation II. This is very concerning.
One of my all-time
The data
favorite
from both the
movie
GAO and Fed's own studies show that Reg II has significantly harmed access to free checking and other
Some of
banking
you will
services for
die,
countries.
but it's a
Or
risk I'm
citizens.
willing to take.
Yesterday, I introduced the Secure Payments Act, which would prohibit final rulemaking until the
does.
Fed, among other things,
Nothing he can say
the
that will make
impact of
him
the
mad.
board's proposed rule, completes a quantitative impact analysis specifically as it relates to affordable banking services for low-income Americans, and reports those findings to Congress. I understand the Fed acted here because you feel you're facing litigation, but I urge the board to proceed with extreme caution
with any type of price control proposals, especially since the first iteration was so clearly harmful. Chairman Powell, knowing of the hardship caused by this policy on consumers, does it give you any pause to continue down this road?
As you know, this rule is out for comment. We extended the comment period to May 12, so we don't have all the comments yet. We'll evaluate them carefully and make an
Look at
assessment.
commodities,
The
guys.
law does assign us a specific job, which is to assess whether an
Gold
interchange
and
fee
oil,
received by a
man.
large debit
They're running.
issuer for processing a debit card transaction is reasonable and proportional to issuer costs. This is the obligation that Congress has bestowed upon us, not something we thought we sought, but that's our obligation under the law, and we don't know what else to do than to keep doing it for as long as that's our assignment. That's all we think we're doing, but I think that the concerns that have been raised will be things that we.
Well, hopefully you'll study this and understand
we
that
will.
from the previous types of rules along
Thanks,
this
Aldo, for
line,
the
that were very
testimony.
detrimental to a lot of low-income, income folks. As you know, the price reductions that were promised during the Durbin Amendment, for instance, the added profits actually went to the largest retailers rather than go to the consumers as they were talked about. 98% was one of the studies that showed
We're
that the
still
retailers
long, yep.
got all the money instead of lowering prices as they were telling us that were going to happen. So I'm very concerned about that. So what's the legal basis for updating your regulation? You've talked about it a little bit. You believe that there is something in the law that says that you need to be doing this updating all the time, or should you be studying it before you actually propose a rule and make all these things more appropriate?
Well, again,
If you need a discount, shoot us a
our
DM
reading of the law is
and we
that
will we'll get you a payment plan. If you want to pay it off in parts, if you can't afford the full price right now, send us a DM. If you do that right now, someone from my team will hook you up with a pay plan.
That's our reading. I think we do a lot of work. We waited a long time to change it. It's been many years since we did change it, but we do quite a bit of work to make this assessment, and we'll review the comments and the data that we get.
One of the things I hope that you consider is the fact that even though it's supposed to be on $10 billion and up, stuff all rolls downhill. And as the last study showed, the smaller banks, the community banks are also feeling effects of this. So be sure and consider that when you start talking and thinking about this. I appreciate that. One of the things yesterday I had two different foreign banker CEOs in my office, and one of them brought up the subject to me, which is very concerning with regards to artificial intelligence being able to impact financial institutions in this country and our banking system. And I tell people, I said, think about this for a second. You find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now,
what does that have to do with JP?
Already with individual, you couldn't tell the difference between that individual and
the Fed isn't in charge in cybersecurity. Go to Palo Alto, Fortinet, companies that do that, and government should be hiring them, not talking to JP about it.
Money, and you have people scared to death by some well-known individual through an artificial intelligence situation. And I can tell you China is watching this like a hawk. They are ready to pounce on this situation. To me, I've got some bills that actually would solve the problem. Do you think there's some issues here we need to be taking a look at?
What does that have to do with JP?
I think we're very focused on AI, many government agencies and law enforcement agencies in particular. It's very challenging. You paint one picture. There are lots of pictures.
Gentleman's time has expired.
It's interesting because the foreign banks
time's
actually are watching this. Thank you.
We'll now go to the gentlewoman from Texas, Ms. Garcia, for 5 minutes.
Wouldn't that be between companies like Palo Alto, which do cybersecurity, Fortinet? Many of these companies, by the way, do have government contracts. Isn't that between Congress and those companies to build out some sort of AI defense mechanism? Why does that have anything to do with Jerome Powell?
Creating a larger labor force. Immigration also increases demand for goods and services. I know you mentioned in your report that that the growth sometime during COVID was held down due to some restrictions in COVID. And
I'm telling you, man, this actually makes me really scared. watching this sometimes, like, these are the guys that are spending all of our money. They're the ones making prices go up. It's not Jerome Powell is sent a demand to spend more money from these guys. These are the ones spending all of our money. I don't know. That's crazy.
I have no judgment on that. I haven't tried to make a parallel assessment, but I'm familiar with the assessment. What they're doing is they're saying more people working, bigger economy. And it makes the economy bigger. It's just arithmetic. If you say that if you add a couple million people to an economy, they'll
Guys,
be
oil is up
percentage of them work,
3.11%
and there will
on
be
the
more
day.
output in there. And that's what they're
Oil
showing.
trade's going crazy right
I
now.
just want to be very, very clear, though, that we don't make immigration policy. We don't
Almost
comment
up
on
10K
immigration
on it.
policy
Crazy.
indirectly or directly.
No, well, I'm not asking you to do that, but Mr. Chairman, I'm simply asking if you agree that the immigration surge has added to our strong labor force, which is necessary. I think you said that we expect a continued growth at a solid pace. So to be able to continue on a solid pace, then we need that labor force. Wouldn't you agree?
Well, so last year we got big increase in workers, and it came from two sources. One was participation increased from people who were already here. And in addition, we got a significant increase in immigration, and many of those people take part in the working economy. And so there was a big increase in labor supply that will have increased output. It will have made more people. It will have all kinds of economic effects. I'm just reporting the facts there.
Right.
I'm not going to say anything is needed for the future or good policy or indirectly or directly, but I mean, I think it's just reporting the facts to say that immigration and labor force participation both contributed to the very strong economic output growth that we had last year.
Right. Is it possible for the Fed to conduct a formal assessment into the positive impact immigrants have on our economy and report back to Congress?
Not really, no. I think that's a job for the CBO. We don't. That's precisely what the Congressional Budget Office does. Not what we do.
Right, but the other question that you're not addressing, did you consider the CBO's assessment?
Every once in a while, Jerome Powell cracks. Like when Elizabeth Warren drilled him one time, he cracked, and I absolutely love it. It's worth the entire stream to catch Jerome Powell kind of like getting frustrated.
Is through February 29th.
So I think that the answer to your question is 10-year growth projections by CBO don't have big implications. They don't have any implications really for the current stance of monetary policy. But I will say that the immigration was a notable factor of the 2023 and 2024 economic outcomes. And of course, we're aware of that, and it plays a role in our thinking about appropriate policy and the path of the economy.
Okay, well, thank you for that. And related to that, I know that the last time that you were here, you and I talked about diversity and diversity and inclusion efforts, both at the Fed, and I applaud you and applauded the president for his appointment of Dr. Adriana Kugler. I expect to visit with her this week. What other strategies and programs are you using in the Fed, not only in here, but in all the branches to ensure that there is diversity and inclusion?
So in terms of intake of people, when we go to hire when the reserve banks go to hire a new president, those processes are very focused on having a diverse applicant pool. And you see the results of that more and more over the years. That happens. We don't have any role in appointments of governors, so that's not our job. The administration does that. In terms of, I'll just say internally, we're very focused on having an open and inclusive place to work. And also in hiring, we work hard to have diverse.
Ladies, time's
Thank you.
expired. The
Thank you, Mr.
gentleman from
Chairman.
Michigan, Mr. Heising, is now recognized for 5 minutes.
Chairman Powell, good to see you. And
I don't know how much longer I can do, guys. I'm running on fumes, and these guys are really irritating me. They keep asking them. Somebody said this. Yes, I generally agree with this. It seems like they just want to talk about nonsense in order to show themselves to the public. These are not nonsensical things at all. These are real important issues. But they're asking it to the guy who just handles the Federal Reserve. Like, these are not decisions that he's making. So what's kind of interesting is I think you might actually be onto something. It might just be, this is just like a PR thing. I know a lot of people are watching these conversations. And so some of these Congress people might be taking the opportunity to just kind of spout their kind of narratives. I don't know. It's really weird, but it's really frustrating. They keep asking Jerome Powell. And a second ago, he got frustrated with one of the questions. She was like asking about something, and he was like, we literally, there's a department for that. Like, we don't do that. Crazy. Yeah, ask the right question to the right people. I think they're doing it intentionally to show face. That's my guess.
Act. The Fed is also looking at Reg II, which in my opinion would unintentionally undermine recent significant progress in bringing low and moderate income consumers into the mainstream banking system. And just yesterday, the CFPB unveiled a rule that would cap late fees for banks. And I just literally walked out of a meeting with my credit unions, who are very concerned about those things that may be in their future as well. So I think it's critical that we don't look at any of these rules in a vacuum, and we need to consider their total impact and full scope on that. So I'm going to ask you a question I've asked some of the other regulators. How much do you, as the Fed, and you personally, consult with other agencies on their own rulemaking agenda? Do you coordinate? Do you talk?
So I don't lead that area of our business, but I know there's a lot of talking. Coordination, I'm not sure there is coordination.
We're in government. There's always a lot of talking. I'm
much
concerned about the
shortage.
coordinating. All right. Well, let me ask you this way. When a rule is finalized under another regulator, are you mandated or have any kind of policy to go back and look at your other pending rules under your purview and see if changes need to be made because of these other agencies' rule makings?
There's no mandate like that. I think where it made sense to do that, though, we would do it.
But you genuinely have some sort of review of that. It's conscious.
I don't think there is a formal review.
Okay.
No.
I've heard repeatedly that elements of Basel III overlap with the Fed's annual stress.
Okay, guys, I think I'm going to call it there. We've gone too far off the rails, and it seems like any market moves that were going to happen may have already happened. Real quick, I'm just going to share my screen, update you guys. During all of this time, notably, a couple things happened. Gold, punching back to that all-time highs, baby. We're real close. Oil, look at oil, guys. Actually, I do wonder if there was something that I missed. Fed is in no rush to cut rates. Crude oil. There was something with OPEC. Meanwhile, Saudi Arabia unexpectedly hikes prices of its main grade for buyers in Asia. It follows OPEC Plus decision on Sunday to prolong output cuts until the end of June to stabilize the markets. Seems like we're getting a little bit of pushback in the price of oil in the OPEC meetings that are going on, and prices are jumping here. We are long oil, so this is a really good trade. For those of you guys who are in the VIP room, I'm going to probably trail my stop loss today on several of my winning positions. I'd like to trail stops on oil, gold, silver. It's time to lock in some more gains on these trades. If you guys would like to join the Discord here, there's a VIP room you can join if you'd like to get access to the signals. We'll drop the link to the to talk to really quick. If you'd like to join the VIP room, get the trade alerts being shared. We've been on fire recently. A lot of rock solid stuff. Also, the 25% off sale for the Edge Finder is coming soon. It's ending soon. If you guys have not already picked up a copy of the Edge Finder, it is currently 25% off. I want to thank you guys for hanging out. We've been live for 2.5 hours, so I'm going to call it good there. And if anything else major happens with Jerome Powell, I'll put out some sort of notice, video, content, etc. Follow me on Twitter if you haven't already. I put a lot of updates there, and of course, join our Telegram channel if you have not already as well. We'll drop that link as well, where we share updates throughout the day. Both myself, Frank, and Julie were putting out updates for our readers. All right. Again, 25% off sale ends soon. If you have not already taken advantage, get 25% off the Edge Finder. Saves you a huge chunk of money. If you've been thinking about getting a copy, now's your chance to get that discount. Just shoot us a DM using the link in the chat or in the description down below. Thank you guys very much for tuning in. Trade safe. Have a great rest of your day. See you guys. Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.